3, 2, 1. Welcome to the show.
Right. Welcome to the show. End of April, actually. Yeah, today's the last day of April. Show post tonight. And so, end of April, which is great because we
We're in the show.
Yeah. I don't think I did it on the newsletter. I don't know if I did it on the show. In fact, I didn't do it on the show. Monthly candles is a big deal. So you get to look at the end of the month, see how the monthly candle looks and the weekly candle and the daily candles. So I did that in the newsletter, but I did not set it up that way for the show. But it's always good to be able to look at the end of the month before you go into the beginning of the next week.
So if you want to see all that, you got to subscribe.
Subscribe to the newsletter.
Because we put all the good stuff in the newsletter.
Exactly.
All right.
Yeah. Go to that one first slide.
The first slide.
Yeah. So it has been a whirlwind of a week. 3 days up in New York City with...
By the way, anybody looking that's going, I don't know what the hell that is.
Yeah. So
it's
kind of cool. The
annual
50th
annual
yeah.
Chartered Market Technician
Association Symposium.
That's not a conference.
No, not a conference.
When you guys are as smart as you guys, you have symposiums.
I don't think I can spell symposium. But at any rate, it was pretty awesome 3 days. Virtually everybody that we've ever referred to on the show was there. Larry Williams, Tom DeMark, J.C. Pretz, everybody was.
And these are all people that are, big names in the technical analysis world.
Yeah. I mean, they're the guys that they didn't start it, but they learned from the guys that did start it. I mean, from like the early 1900s.
Yeah, 50 years is a long time, but it's not, right? I mean, we're over 50, right? So we've been around that long, and you think about something, but that just means there's probably two iterations of when it was
before.
I want to say generations, but it started with a bunch of folks that said, "Hey, we should have an association about this or whatever," a group, and then you probably had another group come in behind that kind of refined it, right, and made it better. And then,
that's what this whole thing was about, really. This 50th anniversary of it. It was great.
I hate that I missed it, man.
Yeah, you would have liked it up there. There was I
just like New York.
Yeah, it was a fun.
We might have been late for a few other meetings.
Yeah, it probably is good that you weren't there. Now that I think about it, because honestly, it went from 7 a.m. to like 9 p.m. for 3 days. It was really, really good. I'm gonna get my thoughts together and put some stuff out about it. I'll try to distill it all down a little bit, maybe for the podcast for next weekend. But I couldn't do it for this one. My brain's still spinning. But it was a great couple days. So for this week, we're going to take a look at this thing called the Rule of 72. A lot of you guys might know what that is. It's a really cool little back of the napkin kind of way that you can relate price and the rate that you're paying and how long it takes for your thing to double. So you can use it in mortgage payments or credit cards, or and it can be on both sides of the equation. So if you lend money to someone, how long does it take for you to double your money? What interest rate do you have to charge that person for you to double your money, right? And the reverse of that is, if a credit card company is charging you interest, how long does it take, for them to get to double their money from you? Like you're paying a lot for a credit card interest rate. So, and then G-fund rate of return, still a lot of people have a hard time understanding. And I saw this article and the chart, which I'm going to show. The chart goes down, right? Because the G-fund rate of return has gone down since its high, which if the G-fund was around in 1982, that would have been the high. But it's been going down every year until last year. It started moving higher. That doesn't mean that you're losing money in the G-fund. And you could think that by looking at the chart. So we're going to just talk about what the G-fund actually is, as opposed to what kind of the stock funds do. And then I just wanted to point out one pretty interesting thing on the S&P 500, which is our C fund, but it's pretty potentially important. And then we'll look at the weekly charts. All right, so Rule of 72, super simple formula, tells you how long it will take for your money to double while you sit back and relax. It's a pretty good article, a lot of stuff in there from CNBC. So it's really simple, right? You take 72, divide it by the interest rate, and that's the number of years that it takes to double. So there's only 3 variables in there. You can play around with them in all kinds of different ways. But here's some examples, right? If you earn 1% on your money, it takes 72 years for your money to double, right? So if you were in the G fund, for example, and you're only making 1%, it would take 72 years for your money to double. That's not great. On the other hand, if you are paying 12% on a credit card, it takes 6 years for that money to double, right? So you don't want to be on the wrong side of the equation. If your money sits in a standard savings account, earns, this is from a year or two ago probably, because right now we're getting a lot more than 0.09%. But if you sit in a standard savings account making 0.09%, it would take 800 years for your money to double. And obviously the bank that has your money, they're only giving you 0.09%. They're using that money consistently and giving you enough only to have it double every 800 years. So if you invest your money in the stock market, whether through an employee-sponsored 401k or a Roth IRA or somewhere else, you'll likely see bigger returns, right, than you would in a savings account. The average annualized return for the S&P 500 over the past 90 years is just under 10%. Okay, so I'll take this to be a fact, right? Average annualized total return for the S&P over 90 years is about 10%. Then if you adjust for inflation, it comes in at about 7 to 8%, right? So if you earn 7%, your money will double in a little over 10 years, because it's the rule of 72. So it'll take 7.2, a little over 10 years. That's great. It's also linear, okay? This is the reality. If you go back here to the top in 1929, it took 25 years. If you had $1,000 in your bank account here, it took 25 years to get that $1,000 back into 1954. So from 29 to 54. So it's not linear, right? Same kind of thing here in the early 60s to 1982, right? It took 14 years to get from this high. Broke up through it, came back and retested it. So that's where because you came back down to the same level. So it took 14 years to make any gains off of that. And then you had 13 years from the top in 2020 into, this was 2013, before we got back above after the housing crash here in 2007. So yes, over 90 years, which is basically this chart. It's actually a little bit, it's a little bit longer. It's about a 100-year chart. Over that time, the market goes up, right? And you could almost apply the rule of 72 over that whole course of time. The problem is, what if your career was this section? I mean, that's a 25-year career, and obviously it's not counting the money that you would continue to contribute, right? So your account the amount that you're contributing to it would grow, but your original amount back here, you wouldn't get that back for 25 years. And we talk about it all the time, the importance of missing these drawdowns over the course of your career. It just cannot be overstated.
Yeah, and you never know when they're coming, right?
Right.
I mean, that's the point. It's easier to look at that chart and go, oh, well, what if, we're doing the what ifs, right? So you can do the what ifs on the other side.
Sure, yeah.
But you don't know when those are coming. Okay. And as you see on that chart, they are reasonably predictable, meaning they do come in
periodically.
Cycles.
Oh, yeah.
It's not just one time that it happened, right? It's basically 3 times in that last 100 years.
Yeah. I mean, if you look at it, you got, a 25-year span here. And then to a top, you have about another, 20 years or whatever of a great bull market.
Yeah.
And if you're in here, you think the market always goes up.
Right.
Right.
And that's kind of where we're at right now with a lot of folks is they've only experienced this, the market always goes up. And, you know, it does in the long term, but if you zoom in, of course, there's times when it didn't.
Right.
And so you can shorten some of these time frames. And what Jerry's pointing out here is that, you know, almost a career span, maybe a little less as you get up there, you know, higher. But the point is that large time frames in your career. But if you shrink that down, why would you even do that for 6 months or a year or two? You know, that's what we're seeing, and that's what we're getting back to that right now. We're in that kind of time frame where why would you go a year or two and not and absorb that time of not really getting any gains? Right. You know, and we forget that, like, because we'll look at, like, if you're holding on to it, right, and you're kind of doing this, you're happy as hell when it's going up, and you're like, oh, I'm making gains. But you don't want to remind yourself that you started over here, up here,
right.
and you're not even getting there yet. And you're like, and then one day you get back there and you're happy because it went up, but you're like, yeah, but if you're being honest with yourself, you're just right back where you started from.
Right.
Not counting your contributions, obviously, right?
Right.
And that's the part that's really hard for people, is because we make this so much about emotions and feelings instead of about data, right?
Yeah, and I think your brain wants to accept these linear, very simple equations. If X and Y, then Z. Mm-hmm. And over certain time periods, that's true. But it's not always true.
You're right.
You know, and you just have to have this is a much broader perspective than what we usually look at. And so every once in a while, I like to pull it out and just.
But this is the basis of why you started using that methodology. You know, I'm showing the chart over long term is, you know, over time you figured out, and not just you, right? I mean, other people figured this out, is that why would I want to take that? Especially considering the restrictions we have within the TSP, right? That we always got to remind that is that, you know, we can't be in and out and in and out and in and out, right? And so if that is the case, you know, what's my best option? And the best option is just to be in the market when it's trending up and be out of the market when it's trending down. Right. That's the best you can do given the restrictions we have.
Right. I mean, the restrictions are hard. But if you look at this chart, the bull markets, I mean, like you said, they happen in cycles, and really it's kind of better to look at it. Maybe next time I'll do it on a time frame basis, but you know, they happen in periodic. It's pretty periodic. There is a whole kind of academic section about price and time and how they relate. But this is enough to kind of show you that if you're a retiree, you get this by looking at it. If you're new, if you're a relatively young investor, you might look at it and say, yeah, but it goes up over time, so I'm good. And the snowball effect, the compounding effect, works when the market's going in both directions. So if you're new and the first 100,000 that you make in TSP is the hardest.
Right.
And so if you're like, well, I've only been in the government for a couple of years, I got, you know, 50,000 in TSP. If I lose half my money, I've only lost $25,000. You've lost so much time and compounding effect, because it's like a snowball. You start rolling it, it takes a long time, and then the bigger it gets, the less amount of time it takes to grow bigger, right? That it's that first part that really matters the most, which is hard to get across to people. Retirees get it. Like, they can't take these drawdowns because your life is going to change immediately if you take a 50% drawdown. But if you're young and you're like, it'll come back. Yes, it'll come back. But
yeah, it's the old kind of saying, like, you know, $100 to me is not $100 to another person, right? If I lose $50 out of 100, maybe I don't feel it. Yeah. Another person might lose $50, and that's huge for them. Right. And that's the same kind of analogy, whereas, like, you're you know, for whatever reason, you're at a state in your life where you're making whatever you're making, you know, in your first 5 or 10 years in the government, right? Some people do a lot better, right, because they go up faster and all those things, right? But let's just say you're making $50,000 to $75,000 a year after being in for, you know, 5 or 10 years, whatever. The point is maybe that, like you said, like, that doesn't feel like as big a deal to lose $25,000. Right. You know, it sucks, but you're not. But it is almost more important than losing half of it 30 years later, because, again, the snowball, right? We want to get our snowball big enough that now it starts to pick up steam.
Right.
And getting that first $100,000 is a big piece of that. And so, yeah, I don't think of it in dollar amounts. I think of it as like percentages of my account.
Yep.
That's how I've been able to wrap my head around it. Am I willing to lose 10% of the total amount that I have in there, whether it's $1 million or 100,000?
Yeah.
Am I willing to lose that? No, I don't want to. Right? Am I willing to lose 2 to 3% either way to keep me in that
Yes, you have to be willing to accept some drawdowns, so that you don't continue to get more drawdowns. Yeah.
Right, and my window has usually been about 3% either way, right? And so some people would say, "Well, that's 6%, right?" And yeah, it is, but I'm not going to take
the 50%,
the
20%,
10%. I'm not going to take those, but I'll have to accept a 6% wiggle room to keep me from getting the 10 and 20 and 30%, whatever, these huge drawdowns.
Somebody put up a table in the Facebook group yesterday.
Yeah, I saw that.
Yeah,
that was pretty cool.
Yeah, it's great. It's a really, really good table. If you're a retiree, you'll get it as soon as you look at it. It tells you.
Yeah, we need to create a version of that we can put on the site. Just I'm sure it's been redone plenty of times, so I'm sure it's not copyrighted by any particular person.
Yeah, no.
But it's just math, right? Yeah. But we need to do a version of that because that's a good go-to whenever someone is not getting their head wrapped around the fact that, like, how long does it take to make up that?
Yeah,
percent?
I mean, how much does it take? I mean, if you lose 50% of your money, you have to make 100% gain on what you have left just to get back to even.
Right, that's the part people miss.
Yeah, it's brutal.
It's a huge mountain to climb, but I think we've beaten that to death.
Okay, so yeah, definitely check out that chart in the Facebook group. It's pretty cool. All right, so the G fund. This is the chart that kind of grabbed me, and what it looks like is that back in 1988, the G fund's about 9%, and it looks like, if I'm getting 9% in 1988, and the chart keeps going down, and I'm only getting 2.2%, in whatever that was, 2019, then I'm losing money in the G fund, right? No. The G fund, the value of the G fund doesn't go down. This is a chart of the returns. It's not a chart of the price of the G fund. And that's the big distinction. The C fund has a price, right? Say the C fund is $10 a share. If the price of the C fund goes down to $9 a share, the value of your account went down by 10%. The G fund doesn't. It's fixed. So let me just go to the next one. So. And this is from the TSP site. This is how they kind of describe it. The G fund is invested in short-term treasury securities specially issued to the TSP. Okay. Payment of principal and interest is guaranteed by the U.S. government. So therefore, there is no credit risk. So what it is it's just a placeholder, and it's only issued to TSP. You can't trade it in the market. It's not actually a bond. It's not actually a thing. It's a placeholder. And based on that placeholder, the government gives you a rate of return that's equal to a whole bunch of bonds in this algorithm, but it's basically short-term treasury rates of return. So this placeholder thing doesn't go up and down in value. It's fixed. What goes up and down in value is the rate of return based on this algorithm, right? So it's kind of tricky to understand. The C fund the C fund goes up and down in value. The G fund does not. The only thing that goes up and down in value in the G fund is the rate of return that you get. And it can't be negative by law. Okay? So although the securities in the G fund earn a long-term interest rate, the board's investment in the G fund is redeemable on any business day with no risk to principal.
So are we saying that my account balance would not go down, it just wouldn't go up as fast?
No, it's not so what I'm talking about is that if you have a share of Apple stock and you bought it for $100, mm-hmm. that share of Apple stock is worth $100. If the next day it's worth $90, the value of your account went down by 10%.
Right. And why is that different than the G fund?
The G fund, does not have, you don't buy the G fund for $100 a share and the share price of the G fund goes down. The G fund doesn't have a share price. It's like a placeholder.
Right.
And on top
it only
of
has a rate of return.
It only has a rate of return.
So in that, and I'm just trying to follow you here,
Yep.
if that means that technically my account balance can't go down because of it,
That's right.
It will just only rise at a pace equivalent to the
Equivalent to
rate
rate
of
of
return.
return. That's right.
So that's what I mean. My money might grow slower,
Yes.
but it won't go down,
Right.
because there is no the value of the share didn't change, right?
Yeah. Actually, there is no value of the share. It doesn't exist. It's a placeholder. It doesn't mean anything.
Yeah, that is kind of hard to wrap your head around. To be honest, I haven't been able to explain that. Like, I understand it, but I haven't been able to explain it. Like when people ask that kind of similar question, it also goes back to why we think that the G Fund is such a great tool. Is because I don't have access to it anywhere else. Like you can get as close as you want in a 401k or an IRA, but nobody gives us that same tool in anywhere else, right?
It's zero risk, and you get a rate of return. That's
right.
In terms of physics, it's an impossibility.
It's impossible,
right?
But they give it.
The government gives it to you,
and so the fact that we would go all 100% of our account and put it in G Fund means at least we're still going up. It may be slowly,
right?
But we're not going to go down. Like that's the point. That's the takeaway. And if people can wrap their head around that, they understand why the G Fund is so important.
Right. And the best example of that was last year. I mean, stocks and bonds both went down together. So whether you were in a very, very safe short-term treasury bond, you still lost money. The value of your account went down. In any bond fund or any stock fund, anything that you did last year, as rates went up, the value of the bond went down. The G Fund doesn't have a value. The only thing it has is a rate of return.
And that's pretty interesting. I mean, it's definitely something. I mean, I know the facts of that, right? But I haven't been able to wrap my head around like why. And so, I mean, this is a good topic to dig into. It's probably going to take people a couple of times to think about it. But I guess the real takeaway here is that's why we promote using the G Fund. And we get so many naysayers. It's like, why would I go to the G Fund? When And I'm like, well, if everything else is going down, why wouldn't you?
Right.
Right.
It's the only thing that you can go to that's guaranteed. So if, there are plenty of people out there that think the sky's fallen. And if they turn out to be right and the sky falls, the only risk in the G Fund, and some people would argue that it is a risk, the only risk in the G Fund is if the federal government defaults.
Right.
And
if that happens,
and that has nothing to do.
Bigger things are going on.
And when I say default, I'm not talking about Secretary Yellen deciding that they're not going to pay the bills this year. It's not it's not that default. This is like if the government completely collapses, then we're not getting our retirement checks.
Right. So it's a different kind of risk there. But the takeaway, though, is that the G Fund is our safe haven, and there's nothing wrong with using it to let the market play out, right? Because we can only take advantage of these larger trends. And so do I want to just watch my account balance go down as the trend, as the trend changes to go down, a bear market, right? Or the overall market is going down. Do I just want to sit there in the market, or why wouldn't I just go to the safe haven of the G Fund? I mean, they created this thing for that exact reason, right? The reason they took out all the risk is, they were doing us a favor, basically, to say, hey,
huge favor.
If all things are going to crap, like, you can go over here. The problem is people don't understand how to do that. They don't teach us, right?
Right. And it's obviously over time, as we showed in the first chart, over time, the stock market is the place you want to be.
Right.
It's just
until
that
it's not.
When it's not, you don't want to be in it. And the place to be is the thing that's going to give you a guaranteed rate of return with zero risk. Yeah. I mean, that is impossible. It's an impossible thing that the government gives us out of the goodness of their heart.
So we can complain about a lot of things about the TSP, but that's a gold mine. When on that chart that you had there a few slides ago, when you hit those time frames in your 401k or your IRA, you don't have a completely no risk safe haven.
Right.
There isn't. You're going to take some losses somewhere. Unless you just go completely to cash, right? I mean, that's a different thing. But if you go into some sort of bond or money market or some combination, there's risk, right? Yep. The G Fund, no risk. The only risk associated is how slow I'm going to get it, right? Whether it's 1% or 3% or whatever it is, right?
Right. That's right. It's opportunity cost, and if there is no opportunity, then there's no cost.
Exactly.
Right. So this is a chart of what the G fund would look like. It roughly tracks the 2-year bond yield. So yield has been declining, which means the price. That's why the F fund has been going up over time until last year. When yield rises, the price of the bond goes down, and yield is what rate of return is in TSP, which is why the rate of return that you've been getting in the G fund has been decreasing over time until it hit a bottom, like I think it was 1%. It might even have been less than 1% in 2020. And then we're seeing huge moves up in the G fund this year, and that's why, because yield came off this 40-year bottom. I mean, this goes back to 1982. It's a 40-year bottom. And so if you drew the trend line, and a lot of people are doing this for a lot of different reasons, but if you drew the trend line of the tops, we clearly broke through that trend. The question is, do we come back down to some level before going higher? And from the G fund, that'd be great, because the rate of return of the G fund would go higher. But what that also means is that this is also interest rates. So it's the 2-year treasury, it's the short-term treasury bond. If it goes higher, mortgage rates go higher, credit card rates go higher, everything goes higher, the economy slows down. Like, this is why this is such a big deal. And the only real positive of this is that the G fund rate of return goes up. So it's a really, the 2-year yield and the 10-year yield charts are pretty important to kind of keep an eye on. Okay, that was kind of wonky, but all right. All right, so I just wanted to show this chart of the C fund because I think this is pretty interesting. So last week on, I can't do it on this. I can't zoom in on this the way we have it now. So last week, you can see this little red tick down right there, and it got below that 20-day moving average line. It reversed. So on Tuesday, it closed down below that 20-day moving average line. And then by Thursday, it got back above it. And then Friday, we put in a high that's a little bit higher than the most previous high. And so I was looking at it, and the last time that we saw a breakdown through the 20-day moving average line and a recovery within a day or two, you don't see that anywhere in 2022, right? Every time we had a breakdown, we're below that 20-day moving average line for a long time, right? They're tradable declines. This was different. And the last time we saw that was all these times back here in 2021. And what was 2021? A bull market. So maybe what we're seeing is price action, the beginning of price action that happens during bull markets instead of what happens during bear markets. It's something that just kind of hit my radar. I'm not saying that it's, the coast is clear and prices rocket higher, but it's definitely a change in, it looks different than this. It looks much more like that.
Yeah, and what I like about this chart, if there is anything to like, right, is that if you assume, at some point the market starts going up again, which it will.
Which it will, yep.
If you pull out, and let's say that chart keeps going, right, and so you're zooming out. When you look at that chart, and I can't see the dates on my screen because it's tiny, but that whole section there will just end up being a pretty large correction. Yep. And it'll be one of those places on that 100-year chart where we generally could have just been out the entire time.
Sure.
Right. If you just wanted to play it safe, you would have looked at that and said, why would I bother? And I just could have sat out the entire time, kept my account balance the same, and then jumped back in once the bull market started. Of course, what we try to do though is when you zoom into those, there's some small opportunities for gain. Yep. And that's where it gets tricky with the restriction of the TSP, right? If we didn't have the two moves and noon and all that, we could play a little bit more with those ups and downs. But I think what you're going to see, I'm sure what you're going to see is that section of the chart is just going to be in one large correction.
Right. let me flip back to this real quick because that's kind of interesting. This is a monthly chart, and obviously it goes back to 1929. So it's perspective, right? And it's also logarithmic. It's a logarithmic chart. So that's how you can get all this data on one page. We're starting down here at a price of $2.30, and you get up here to 5,100 or whatever. And actually, the top was 4,800. So, but you're getting from $2.30 to $4,800 on this one chart. So you have to do it logarithmic. You can't do it in terms of straight price. But so logarithmic basically means from 100. Let's see a good way to do this. It's 100 to 200. Right, this distance is a 100% move. So let's see. Let's say it's to get a 50% move down from 4,800 is to 2,400. So that's like right here. This doesn't look like much, but it's a 50% drop in the value of your account. So you really have to look at these charts like with an understanding of the perspective of it. This was a 50% drawdown. This was almost a 60% drawdown. This was a 79% drawdown. So if we saw, obviously you can't have 100%, right? Because that's ridiculous. It takes you down to you can't have 100% drawdown. But if you had, say it was at 5,000, and you had a 90% drawdown, it would take you down to 500, which, is like there. So yes, would that look significant on this chart? Absolutely. And it would actually take you out of the range if you connected the trend lines. But that would be a 90% drawdown. Just to say that you got to really understand what you're looking at when you're looking at the charts. Because this isn't just a little blip. And this was so far that from this high to this low was 27%. Okay. And then we did this. So yeah, are we getting? Is price starting to act more like it does in a bull market? Let's hope so. We shall see. Okay, TSP fund charts. Yeah. Hope is not a good plan, but at least if you're paying attention.
I was pointing to this when Jerry said that. This is hope is not a good plan. I keep that as a nice little reminder over here that hope is not a plan. It's not a good plan. It is a plan.
Yeah, I mean, I hope too, but it's along the lines with hope and verify, like trust and verify, but hope and verify. Yeah. Okay, so this is now it's getting longer than a 3-year chart, but I always like to go back and keep COVID.
If we lose perspective of that, it changes everything.
Yeah.
And so I think it's useful that we use that regardless. And, I have had a couple people ask me, why. And I think it's, again, because most of all of this, you just showed it on the logarithmic versus all of this is about perspective.
Yep.
And so you have to give yourself several, it's what we always talk about, zoom in, zoom out, right? And maybe zoom back in again. Perspective is everything, but you have to have all these perspectives to kind of get an idea of what's going on, right? If you just look at one thing, one perspective, you're going to get crushed.
Yeah.
You just don't have enough information. And so keeping that in there, I think, is very important.
Yeah, it gives us for a lot of reasons. I mean, one of the big ones, here's the high right before we went into COVID. We came close to tagging it in October. Mm-hmm. And this was also the 200-week moving average line was moving through here at the same time. So this was a pretty good bottom, whether or not it holds, but if it doesn't hold, one of the next things that everybody's looking at is this 3,400 level because it's the prior high, before COVID. So it should act as support. So anyway, yeah, it helps for perspective. And so where are we right now? This week was really a pretty interesting week. I mean, price comes down, hits that 20-week moving average line, and on Thursday and Friday recovered back up to new highs. So that's a huge bullish candle for the C fund. And if this support holds, that would be awesome. Basically, you can't really see it on here, but 4,200. Yeah, this is the 4,200 line right here. So 4,200, it was support here. We had a big gap down through it here, a bit of an overshoot at that August high, resistance, resistance, resistance. If we can get above that 4,200 line, then there's a chance that this thing keeps moving higher. This is a great first start. We got support on the downside. Now we just need to get up above that 4,200 level, and we're probably off to the races. If you're just looking at price, it looks really good. If you're looking at for confirmation from relative strength, it's not so great because it's basically flat. Yes, it's above 50, but it's basically flat. MACD is not bad. It's expanding to the upside. Everybody is looking for price to get back above 4,200 and ideally back above 4,300 at that August high before institutional investors start putting money, really big money, back into the C fund. S fund is the biggest problem right now because if this October low is going to be the final low of this bear market, small cap tech stocks should be leading us in the next bull market, and that is clearly not happening. You got either if you connect these highs and these lows, you have a channel. So either the S fund is forming this horizontal channel, which in that case, price can keep moving up and down in that channel before it either breaks to the upside or breaks to the downside, right? That's one possibility. The other possibility is this left shoulder, head, right shoulder, and a neckline right there. So if price gets down below this neckline, it most likely continues lower. So in the short term, that's what we're looking at for the S fund, where we've been in this consolidation below 50 on RSI, and MACD is right on that zero line, but it's negative. And so technically, the chart by itself doesn't look good. And if this is the beginning of a new bull market, the S fund is not playing, and that's not good. I fund holding up super strong. Ever since this breakout, came back and tested it here last month, and it's holding up pretty well. It's gonna probably hit some resistance here, but at its if it's gonna put in new all-time highs, that would be awesome. There's a lot to talk about where money is flowing and how the recession is going between the U.S. and Europe and Asia, but the I fund, if you want to be in a stock fund at all right now, obviously the I fund is it. F fund is everybody's nemesis right now. The idea is that most analysts coming into 2023, and they still expect stocks to go down and bonds to go up, right? That's the expectation. What we have in the chart right now is this expanding triangle pattern, and it is the worst chart pattern because you got higher highs and lower lows. And so as the triangle opens, you got more of a percentage move before a decision is made that you actually have a breakout. It's hard to see when the breakouts happen because you have higher highs and higher lows. So you can, if you can trade in between there, that's fine. But it's very difficult. And you have RSI that's not really helping us very much. It's kind of oscillating along that 50 line, and MACD is moving higher, but it's generally flat. Even as price is moving higher here, you got MACD still well below the high from January. So it doesn't look like the F fund is getting ready to explode higher and stocks to explode lower. It's just, we're not seeing it in the chart yet. Could happen, but we are not seeing it yet. All right.
My favorite slide.
That is.
Questions.
It might have been a little bit of a struggle to pull it together this weekend. I'm still I was driving all night last night to get back here.
Yeah, a little
and put
shell
this thing
shocked.
together. So yeah.
There's a lot going on this week. Can't wait to get some insight into all the fun stuff you did there.
Yeah.
I have to make it next year. Is it going to be any place fun? Did they announce where it's going to be?
They did not. I actually poked around about that, and nobody would give it up. Before we forget though, the Fed is meeting this week.
Yeah, it's Wednesday.
Yep.
And we are going to be on the road traveling again. But all's good.
Yep. We'll figure out a way
We'll be watching.
Yeah.
All right, guys. If you have any questions, you can put them in the comment section wherever you found the video. If there's not a comment section, just shoot us an email. support@growmytsp.com, and they will forward it on to us. Hope you guys have a great week. I hope it is a good time of the year for you. We're getting close to summer, so warm weather. Hopefully a little bit more time outside.
Good stuff.
We'll see. All right, you guys. See you later. Ooh, that's kind of loud.